But I do know that the demand for gold is likely to get out of control, if you like, when want to put it in those terms, before the average American, the average European, the average Brit wakes up to actually what it's all about, and that is the collapse in the purchasing power of their own credit. Get out of credit. Get the hell out of credit. I mean, if you look at the dollar, look at the euro, look at any of these currencies, and all you can see is disaster. Well, basically, I don't make forecasts. What I was doing was merely saying what the chart is saying, because it's broken out of a very, very bullish consolidation. An upward sloping flag, which found support on the 55-day moving average. It's very, very simple. It's a very bullish chart, and it's just a question of measuring in, the move into the flag and adding it to the move out of the flag, and that gives you $3,000. I mean, this isn't a forecast. This is just what the chart says. And I would conclude, I think the big bullion banks have probably got their books square or got some gold on the books because they understand what's going on.
Word on the street is that JP Morgan and others, who are members of the Shanghai Futures Exchange, have intelligence that's almost as good, if not better, than what the government has. So, when it comes to those big players, there's not much to worry about. But when you look at the smaller bullion banks, it's a different story. They're probably getting into trouble as prices rise, which is reflected in the COMEX shorts. It's said that positions in London are usually much larger than those on COMEX, though COMEX tends to be more volatile in terms of price due to the relationship between managed money, the hedge funds, and the swaps, which are primarily bullion bank trading desks. London might be less volatile but handles bigger volumes. The buzz is that the swap short position is around $70 billion, roughly $25 billion each on average. That's a hefty position, and they can't claw it back. Sooner or later, someone with a larger than average exposure could be in trouble. As prices rise and hedge funds buy more contracts created by the swaps, a rescue might be inevitable, likely happening behind the scenes. We might never hear about it, but there's bound to be a crisis or two that we aren't privy to.
We're already in recession. I think it's very, very simple. And as that gets worse, because recessions don't just stop, it is going to get worse with all the banks with their balance sheets over leveraged and all the rest of it. They're not going to provide extra credit. I would say that it's very likely that the deficit situation, budget deficit situation, is just totally out of anyone's control. And that is, and how are they going to finance it? Again, I come back to this problem. They're in a debt trap, 130% debt to GDP. China has decided that it's reducing its involvement with dollars. And this is for geopolitical strategic reasons, though I would guess that the people in the PBOC who are not idiots can see what's going on. They will be making a similar assessment to the one we're discussing right now, and basically will want to get out of dollars as much as possible, as quickly as possible. That is why they've been buying gold. Now, they haven't stopped buying gold. They've said they've stopped buying gold, but do you trust what they say? Never trust anything a government says or a government department says. So, but I do know that the demand for gold is likely to get out of control, if you like, when want to put it in those terms, before the average American, the average European, the average Brit wakes up to actually what it's all about, and that is the collapse in the purchasing power of their own credit. Get out of credit. Get the hell out of credit. If you look at the dollar, look at the euro, look at any of these currencies, and all you can see is disaster. Putting to one side the developing World War III, which hopefully will be avoided, which one of the other guests, actually, Gilbert Doctorow, specializes in following very, very closely, and I'd recommend people to tune into his Substack if you really want to discover what's actually going on with the war rather than what we are told in the mainstream media. And basically, the central banks are all bust. They're all in negative equity. If you account for it properly, for all the bonds they have bought at far higher prices than the current level, with yields far lower than the cost of financing their holdings. We've got commercial banks are trying to reduce their exposure to risk. And that means that zombie companies are going to be threatened. The inflation story isn't over. I mean, just the root of inflation is basically budget deficits. And, with the next president of the United States, and I don't care who it is, that deficit is going to increase. You're looking at a budget deficit, I think, perhaps in the next fiscal year, starting from September, of over 10%. Now, that just feeds into inflation. It feeds into a fall in the purchasing power of the dollar. And other countries are in exactly the same position. In fact, the dollar is probably in the worst position because it's got a debt to GDP, government debt to GDP, of around about 130%.
Alasdair Macleod stated that we're in a debt trap, particularly with China and Japan, the two major foreign holders, now being net sellers. He questioned whether it's wise to stay in credit, which is essentially currency. Macleod emphasized that currency is indeed credit, pointing out that if you look at a central bank's balance sheet, the currency is listed as a liability, making it your counterparty, and they're all bust. Therefore, he advised getting out of credit. According to Macleod, the best move is to invest in real assets, particularly gold for value storage and silver for smaller investments. He referenced the UBS team's forecast that gold prices could reach $2,600 to $2,700 by mid-2025, supported by lower US interest rates and a weaker dollar driving inflows into gold ETFs and boosting investment demand. This could be the beginning of a broader global shift towards real assets, he suggested.